Thank you, Annette. Good morning, ladies and gentlemen. I'm really delighted to have the opportunity to participate to the Eurex Derivatives Forum, both individually and as a member of a representative of Deutsche Bank here today. Deutsche Bank, once again, very proud to be a prime sponsor for what is Europe's leading derivatives event. I have to admit that my original speech was a rather different one to the one I'm going to give today. I was going to talk about how to navigate macro uncertainties, and in particular on how to improve European capital markets to achieve that. I guess it's fair to say that the last few days have given us a lot of new material on the topic of macro uncertainty. So I thought I would start my speech by first offering you my views on recent events and some of the early conclusions we may be able to draw from these so far. And then, as originally planned, take a look and give some comments on how to navigate competitiveness issues in the longer term. So I'll start with some comments on the current situation in the financial sector and the events of the last few days. Without going into particular specifics, I think two things were really worth noting. The first is that the cooperation between all parties and their ability to create a viable solution in such a short period of time has been truly remarkable. Second, this was complemented by close international coordination with the central banks globally providing support from the sides and by making additional liquidity available to the markets. This has obviously contributed to calmness. And it is a good sign that after a more turbulent initial market reaction on Monday morning, financial markets seem to have adopted a more constructive reading of the current situation. So does that mean that we have seen the peak of the volatility of the last few days? Unfortunately, no one can really say that. But what's important in my view is that the current situation is not an indicator of the underlying health of the broader European banking sector. Why do I say this? Well, it's because I would encourage us to look at the fundamentals. The European banking sector has really made a very significant progress since 2008. For me, there are 5 points that are really important here, and they're also explain why a few specific names have been experiencing difficulties, while the vast majority of the sector is in robust shape. The first key requirement of any bank to get through such a volatile situation is a strong capital base. Regulators in Europe have done an excellent job here after the financial crisis to improve capital levels of banks across the board. They've significantly tightened the rules and requirements, and in my view, the vast majority of regulation that came in after 2008 was spot on. Improved capital levels provide the sector with stability. And banks' capital has not only increased in absolute terms, but the definition of what counts as equity has also been materially tightened. Overall, today, capital levels of European banks have more than doubled since 2008 as a result of all these measures. The second key requirement is liquidity. And here too, I believe that we are very well equipped as European banks. Regulation has been helpful in this regard as well, given that the liquidity coverage ratio that we all have to adhere to has provided materially improved transparency, and the European banks here fare very well in that regard. Third requirement is to ensure that the deposit base is broad and stable. As an example, at Silicon Valley Bank, deposits were concentrated on a very homogeneous group of clients, and around 90% were bigger than the $250,000 level, so not protected by the Federal Deposit Insurance Scheme. Most European banks have a very different funding profile, with a far more diversified deposit base, making them less exposed to developments in specific industries or decisions taken by a few individual clients. Deutsche Bank, for instance, has no such concentration risks. We have over 620 billion euros in deposits, almost half of which come from retail and private customers, and are therefore very stable and highly diversified. Another close to 40% comes from corporate customers, with a significant portion of those from German small and medium-sized companies, again, highly diversified. The fourth key requirement is that banks have a business model that works and is capable of generating sustainable profitability. In the years since 2020, we have been dominated by various crises, but we have seen that European banks have been profitable throughout, which is proof of the stability and resilience that they now have. That's why also our strategy at Deutsche Bank has been to achieve sustainable profitability as a major priority of our restructuring process, and we've shown that also in the results of 2022. If you take these four things, capital, liquidity, stability and breadth of deposits, and a business model that ensures sustainable profitability, then banks stand on secure footing. But there is one more point which is critical, and that is a consistent regulation. We've been calling this for a long time. Europe has made very strong progress on this, as the ECB and EBA rules span now banks in the Eurozone and the European Union respectively. But still there are some inconsistencies. And so, for example, different national capital buffers imposed on top of the general buffer set by the ECB, and the even more fundamental problem of non-banks providing banking-like services without being regulated accordingly. That should not be the case. The same circumstances should be regulated in the same way, ideally across all regions and across all banks. This is not just about establishing a level playing field, but above all, it is about managing risks consistently. Since last week, we've seen once again that risks cannot be limited locally, but can spread around the world really quite quickly. And that is why we need this one regulation approach, also to ensure that we maintain the global competitiveness of European banks. And this brings me to the broader view of our economy. And it deserves our time and effort because away from the current market volatility, there are a number of long-term challenges. There are several equally important issues, but today I would like to focus on the future of Europe, particularly the need for deeper capital markets, which will help to drive our transition to a more sustainable economy. I think Michael Peters referred to it in his opening remarks as well. We cannot talk about risks or solutions in Europe without first pausing to emphasize the awful war just 1,600 kilometers to our east. The war against Ukraine is a great human tragedy, and I think the images of suffering and destructions deeply continue to affect us. It is also a very significant political and economic challenge, and one which unmistakably marks a new geopolitical era, which will be characterized by multiplying conflicts, greater isolationism, protectionism, and rising nationalism. And at the same time, we face arguably the most serious transformation of our generation, and that is the shift to a resource-efficient economy. These challenges will be the decisive test of how well Europe functions under pressure. Europe has what it takes. After Russia's invasion of Ukraine, the EU states have shown that they can make a very difficult decision together. At Deutsche Bank, we see 5 concrete measures that Europe needs to tackle as a priority in order to navigate this uncertainty and address these challenges. First, we must reorganize our energy policy. We cannot be deceived by the recent easing of gas prices. And in fact, the gas will remain more expensive and supply more constrained than before for years to come. As a result, it must be an EU-wide goal to consistently expand renewable energy sources, and we must consume less energy overall. And this requires investments in more modern power plants facilitated by tax investments. And in the meanwhile, it is important to guarantee a secure and diversified energy supply for our companies. We should be encouraged by the dynamism with which Europe has moved forward on sustainability in recent years. And our companies, research facilities, institutions have become really global pioneers. And we must defend this lead. And that is why my second point is that we need to drive the green transformation forward with vigor. The opportunities are immense and diverse, but the financing need is equally large. For example, McKinsey estimates that the European Union will need to invest close to €1 trillion a year in clean technology to reach its net zero targets for decades. Others are catching up fast, especially the US, with Biden's administration's recent IRA, $374 billion in subsidies for climate protection and the strengthening of future industries. Europe must also think bigger and understand the green transformation as a strategic initiative to strengthen its economy. Mind you, I'm not suggesting we should embark on a subsidy race, but it would already help a lot if it were quicker and somewhat less bureaucratic. This brings me to my third point. On green transitions, our clients tell us that they have difficulty navigating complex rules and regulation. And these can be a burden on wind and solar power providers, for instance, but affect all sectors. To reiterate, I do appreciate the benefits of regulation. And for example, the EU was clearly an early mover with its taxonomy process, which created a real competitive advantage. We, however, need to be careful to keep regulation simple and practical. To stay with the taxonomy examples, the current EU ESG framework has around 2,000 pages of rules and guidelines, which many companies, and especially small and medium enterprises, can find overwhelming. Another area that needs simplifying is immigration. To get the workers needed to support a dynamic, successful economy, we have to be more open to targeted and qualified immigration. Europe cannot afford to stop at national or international borders in the search for the best talent. Lastly, immigration alone will not be enough. We must, and this is my fifth point, also modernize our education systems. We need to consistently orient these towards the technologies and skills that the economy will need in the future. And we must ensure that more Europeans have access to the best possible education. That's the only way that we will get more highly qualified skilled workers. These 5 measures, a new energy policy, accelerated green transformation, more flexible regulation, facilitated immigration, and a push on education, are reforms that member states can initiate and implement. But they will only be truly effective if we break away from national thinking and harness the power of a common Europe. Today, that means almost 500 million people and an economic output of 11.5 trillion euros. Yet, the single market is still not nearly complete. Companies are still subject to different rules in different submarkets, and many of our institutions are too slow and too restrictive. And that leaves an enormous potential still untapped. Of course, a common market means that the individual member states also have to give up some of their sovereignty. But if we are serious about Europe, we must finally deepen integration. In an increasingly polarized world, it is essential to a prosperous future. The most important thing that we can create, that can create the conditions to normalize cross-border capital in Europe and to get investors on board. Because without sufficient financing, we won't be able to implement the measures I highlighted. And our economy will be less competitive and influential versus the US and China. The increase in geopolitical tensions and recent market volatility only increase the urgency for Europe to accelerate work on deeper and more liquid capital markets. That's why Europe needs to play the ace it has held for a long time, a capital markets union, which would be Europe's most constructive economic engine. Europe must find the capital necessary for future investment in the 5 areas I highlighted, and I strongly believe that our continent will struggle to achieve sustainable transformation without a capital markets union. As I mentioned earlier, deeper European capital markets would also expand financing opportunities for companies and attract funds from global investors. And there is no lack of interest on either side, both issuers or investors. Our corporate clients tell us that they want to continue to raise finance in Europe, but need more liquid, and more diverse options. And all over the world, investors tell us that they are eager to invest in Europe. They value our companies, our innovation, and they also value our strong democracies and liberal values. The potential, it is as clear as it is large, but our small national capital markets simply do not offer the necessary conditions today, which is why their commitment remains well below its potential. As a result, despite years of attempting to progress a capital markets union, banks still provide about 70% of corporate financing in Europe. In the US, by contrast, about 60% of companies are financed on the capital market. The time to act is now. The window of opportunity to act is clearly starting to narrow, and we need to start with targeted changes ahead of the European elections in May 2024. The EU capital markets framework is still deeply rooted in national provisions, which have developed over decades, and they really do hamper cross-border provisions of capital and services. And we need to make consolidation across the EU market infrastructure a priority as well. As we heard also a few minutes ago from Klaus Löber on the example of CCPs, the European capital markets are still highly fragmented, and this is leading to inefficiencies in the application of the regulatory framework and supervision. In Europe, we still have 3 times as many exchanges as in the US. We have 18 CCPs, 22 central securities depositories. The US have 1 of each. Clearly, there is an opportunity here. And the opportunity cost for capital markets union are immeasurable. At Deutsche Bank, we believe that the case is compelling, and we see strong support at the EU level, but we need new member states to show the willingness, as they will all benefit. This is not about creating additional business opportunities for banks. It is about laying the foundation for financing and thus enabling the future success and sustainability of our economy. So, ladies and gentlemen, Europe needs to make decisions which will crucially determine our social and economic future and our ability to successfully transform to a sustainable future. It can do so with the confidence that it is supported by a fundamentally robust banking sector. The last 2 weeks also underlined the need for consistent regulation. Europe is really great at bouncing back more strongly from major uncertainty, and I'm hoping that the recent events will create an impetus for us to re-energize the need for a united and more liquid capital market across the region. This would greatly diversify funding choices and boost overall stability for banks and the wider community. Policymakers and member states must consider the broader challenges facing Europe and how they can be addressed by specific reforms, including on capital markets, and pursue them as a priority. At Deutsche Bank, we want to be a thought leader on these issues because our clients tell us that they're necessary, but also because we believe in a stronger Europe. I'm really looking forward to a discussion of all of these topics in more detail on the panel. Let me conclude by saying that we really are proud to be a sponsor of events like these because they're really essential in driving debate. Only if we work together, industry, policymakers, regulators and others, we will be able to design a framework that contributes to making Europe more strategically autonomous and able to handle the transition to a sustainable economy. We're ready to lend our expertise and enthusiasm wherever needed. Thank you very much.